Alfonso Cahero, A Journey into Finance History. Chapter 23, Establishment of the Bank of England, 1694. The establishment of the Bank of England in 1694 was a pivotal moment in English economic history, occurring during a period of profound monetary instability. Throughout the late 17th century, England experienced frequent wars, fiscal crises, and currency devaluations that eroded public trust in the monetary system. The government's reliance on ad hoc financing methods, such as borrowing from wealthy individuals and issuing short-term debt, only exacerbated these problems, leading to persistent inflation and economic uncertainty. The need for a stable financial institution became increasingly apparent as the challenges facing the English economy mounted. Merchants, bankers, and policymakers recognized the importance of establishing a centralized bank that could provide reliable financing to the government, regulate the money supply, and restore confidence in the currency. Such an institution would be essential for funding wars, infrastructure projects, and other government initiatives, while also ensuring the stability of the financial system. The idea of creating a national bank gained traction among England's financial elite, who saw it as a means of addressing the country's economic woes. In 1691, a group of merchants and bankers led by William Paterson proposed the establishment of a bank that would serve as the government's banker and lender of last resort. Their proposal called for the bank to issue banknotes backed by government securities and to provide financing to the government in exchange for interest-bearing bonds. The proponents of the bank argued that such an institution would not only provide stability to the financial system, but also stimulate economic growth by facilitating trade and investment. By issuing a uniform currency that was backed by the full faith and credit of the government, the bank would eliminate the uncertainty and mistrust that had plagued the English monetary system for decades. In 1694, Parliament passed the Tonnage Act, which granted a royal charter to the Bank of England and authorized its establishment as a private joint stock company. The bank was capitalized with $1.2 million raised through subscriptions from wealthy individuals and institutions. In return for its capital investment, the bank was granted exclusive privileges, including the right to issue banknotes and to lend money to the government. The Bank of England officially opened its doors for business on July 27, 1694, with a mandate to manage the government's finances and regulate the money supply. The bank's first governor, Sir John Houblon, and its directors immediately set to work establishing the institution's operations and laying the groundwork for its future role in the English economy. From its inception, the Bank of England played a central role in stabilizing the English economy and financial system. As the government's banker, the bank provided a stable and reliable source of financing for public expenditures, including wars, infrastructure projects, and debt repayment. By managing the government's finances and issuing banknotes backed by government securities, the bank helped to restore confidence in the currency and ensure its stability. The Bank of England also played a key role in regulating the banking industry and overseeing the payment system. It established a system of regulations and standards for banks operating in England, including requirements for capital reserves, reporting, and lending practices. Additionally, the bank acted as a lender of last resort, providing emergency liquidity to banks and financial institutions in times of crisis to prevent systemic collapse. Over the years, the Bank of England evolved into a central bank with expanded responsibilities and powers. As the English economy grew and became increasingly complex, the bank's role expanded to include monetary policy, financial regulation, and oversight of the payment system. The bank's governor and directors became key figures in shaping economic policy and managing the country's monetary affairs. One of the bank's most important functions was the implementation of monetary policy, which involved controlling the money supply to achieve economic stability and price stability. The bank used a variety of tools and instruments to influence interest rates, credit conditions, and inflationary pressures, including open market operations, discount rate adjustments, and reserve requirements. Additionally, the Bank of England assumed responsibility for overseeing the banking industry, and maintaining the stability of the financial system. It established a system of regulations and supervision to ensure the safety and soundness of banks operating in England, including requirements for capital reserves, risk management, and corporate governance. The bank also played a key role in overseeing the payment system, ensuring the smooth functioning of financial transactions and settlements. Overall, the Bank of England played a central role in shaping the course of English economic history, providing stability, confidence, and leadership in times of crisis and prosperity alike. Its establishment in 1694 marked the beginning of a new era in English finance, laying the groundwork for the modern central banking system and setting the stage for centuries of economic growth and development. In its early years, the Bank of England faced numerous challenges as it navigated the complexities of its role as the nation's central bank. One significant challenge was the need to establish its credibility and build public trust in its ability to manage the country's finances effectively. The bank also grappled with issues such as counterfeiting, which threatened the integrity of the currency and eroded confidence in its banknotes. To address these challenges, the Bank of England implemented a series of measures to strengthen its operations and enhance its reputation. It introduced new security features to deter counterfeiting and ensure the authenticity of its banknotes. The bank also worked to improve transparency and accountability in its operations, providing regular reports on its financial condition and monetary policy decisions to the public and Parliament. Additionally, the Bank of England adapted its policies and practices in response to changing economic conditions and emerging challenges. It developed new tools and techniques for managing the money supply and stabilizing financial markets, including the use of open market operations to influence interest rates and credit conditions. These early adaptations laid the foundation for the bank's future role as a leading central bank. As the English economy grew and became increasingly interconnected with global markets, the Bank of England's responsibilities expanded to meet the demands of a changing financial landscape. One area of expansion was the bank's role in managing the country's international reserves and exchange rate policy. With the rise of international trade and finance, the bank played a central role in stabilizing the value of the pound sterling and facilitating foreign exchange transactions. The Bank of England also took on new responsibilities in regulating and supervising the banking industry. It established a system of prudential regulation to ensure the safety and soundness of banks operating in England, including requirements for capital adequacy, risk management, and corporate governance. The bank's oversight helped to maintain stability in the banking sector and prevent financial crises. Additionally, the Bank of England became increasingly involved in supporting economic growth and development through its monetary policy decisions. It used its influence over interest rates and credit conditions to stimulate investment, consumption, and employment, particularly during periods of economic downturn. By adopting a proactive approach to monetary policy, the bank played a critical role in promoting economic stability and prosperity. Throughout its history, the Bank of England has played a central role in managing financial crises and maintaining stability in the financial system. One of the earliest crises the bank faced was the South Sea Bubble of 1720, which saw a speculative frenzy in the shares of the South Sea Company lead to a market crash and widespread financial losses. In response, the bank provided liquidity to the market and worked to restore confidence in the financial system. Subsequent crises, such as the Panic of 1825 and the financial turmoil of the late 19th century, saw the Bank of England take decisive action to stabilize the economy and prevent systemic collapse. The bank acted as a lender of last resort, providing emergency liquidity to banks and financial institutions facing liquidity shortages. It also worked closely with the government and other authorities to implement measures aimed at restoring confidence and stability in the financial markets. The Bank of England's role in managing financial crises has evolved over time, with the bank developing new tools and techniques to address emerging challenges. In recent decades, the bank has played a key role in responding to the global financial crisis of 2008 and the COVID-19 pandemic, providing unprecedented levels of liquidity and support to the economy to mitigate the impact of these crises. In the 20th and 21st centuries, the Bank of England underwent a process of modernization and technological innovation to keep pace with the evolving needs of the financial system. One area of innovation was the adoption of new technologies to improve the efficiency and security of the bank's operations. The bank introduced electronic trading platforms, automated clearing systems, and real-time payment networks to streamline financial transactions and reduce operational risks. Additionally, the Bank of England plays a crucial role in supporting the UK government's economic policy objectives, particularly during times of crisis or uncertainty. In response to the COVID-19 pandemic, for example, the bank implemented a range of measures to support the economy and financial markets, including lowering interest rates, providing liquidity support to banks, and purchasing government bonds through quantitative easing. Overall, the Bank of England remains a key institution in the UK economy, providing stability, confidence, and leadership in times of economic challenge and opportunity. Its role continues to evolve as it adapts to changing economic conditions, technological advancements, and global trends, ensuring that it remains at the forefront of central banking in the 21st century.